All right. Good morning, everybody. TGIF. Not really, though. I got plumbers coming. They're going to go rip my yard up and make a big mess, tear my fence down. Not a good way to start the weekend. Spot Gamma's founder's note is broken. So if anybody's wondering why I didn't share the AM edition, there's nothing here, right? If we all have seen the earlier October stuff, right? I've shared it over the last few days. Those are gone. September is still there if we wanted to go back that far, but who the heck cares? So when they fix this, I will share the founder's note. It happens, like there's no service out there that has glitch-free history. Everything eventually has an issue. They'll get it fixed. They've been really good about it in the past when there was issues. We'll deal with it when it comes out. Right. So uh, that's why I haven't shared the founder's note. We're supposed to get job numbers this morning, but we're not going to get job numbers this morning. Of course, there are proxy ways to try to spot what the potential numbers are, and a lot of analysts use the tea leaves to try to figure out what the projections are. But at the end of the day, if we don't have the hard data, then it's just speculation, right? And there's always a little bit of gut in that, and you shouldn't be using your gut. So, now we'll see if the market cares. So far, we've just continued to see a market that throws aside all risk and continues to ride to the upside. Europe is up 0.5%, small caps leading in the US space, and then Hong Kong basically flat. We got nothing. I think today could go one of two ways. It is really boring and we get nothing, or we actually start to move. And at this point, I wouldn't care which one it is. Been reasonably decent trading otherwise. Take what we can get. We are going to get some Fed members speaking today, all the way through into the afternoon, even with a TV appearance. So, yeah, not likely to hear anything new out of them. Going to be the same old, same old. FX Street is now on TikTok. Okay. I guess that's better than all the kitty cat videos. I'm not knocking it. I like those kitty cat videos. I did need to replace that fence, but it's just gonna I'm just really hoping it doesn't rain while they're doing this big dig. What an ungodly mess that's gonna be. Good thing is we've been dilly-dallying about planting grass and redoing the yard, so now we got an excuse. No auctions today. It's just going to be Fed speakers all day long. I heard him say on Bloomberg this morning that there has been 100% more M&A deals by large cap companies this year. 100% increase in M&A deals within large cap companies this year. It's massive. And they're like, oh, we're just getting started. It should carry on into next year. Goodness, there's a lot happening behind the scenes that continues to support this drive higher. And it just seems like the market can't go down. Every time it tries, they just run it back up again. That'll end eventually, right? But until it does, I'm going to keep warning, we don't have any reason to short it yet. Tesla's getting sued because of their doors. Apparently, 3 people died last year in a fire, saying the people that are suing Tesla says it was a death trap and that their family members died because they couldn't get out of the vehicle after the crash and they died of smoke inhalation. All right, so we attempted an inside day breakout last night. It failed. We came back in again. It doesn't look like the kill zone move. Yeah, no, it was way later than that. For the kill zone, it's just what we've been seeing lately. A nice liquidity gap down and then a run back up to close the gap. It all happened really fast and then that was that. $66,000 in the overnight, so we're still running on the average. And putting it all out here on the daily, if we was using OCR, it's just higher highs and higher lows, right? We had that discussion yesterday about the lower high pivot and whether or not it was actually going to be a lower high. And we continue to see that we don't have one, right? We came up and we're just steadily rising. Now, the concern becomes how far away we are from this 10-day moving average or the 10-week moving average when we get to that chart. When we get, quote, too far away, we tend to stall out there and it becomes harder to go higher. So, it's not putting a ceiling on it. It's just saying that once you reach a certain point of no return, going higher than that becomes exponentially more difficult. The analogy that I've always used is a runner headed up a very steep hill. We're not going to try to stop that runner, but we're going to continue to put more weight on their back as they go. So sure, they can keep going. They just have to put more and more and more effort into doing it because we're going to keep stacking more and more and more weight on their back. That's what happens when you start getting too far away from that 10. We can still do it. It's just going to take more and more effort. So we're getting to that point, but we're not quite there yet. We'll see it on the other chart. Today's levels are mostly involving that combo 3, and if we break that, getting down into the large gamma level. That's large gamma 1. To the upside, we got combo 2, and the call wall rolled even higher again yesterday. Now, it rolled again last night. So we rolled yesterday. That was one. Then we rolled again last night into today. When it just happens once, I don't put too much weight behind it because we've seen where it moves up and then the next day it moves back down, or it moves down and the next day it moves back up, and it just kind of fluctuates. But if you get repeated rolls in the same direction, higher and then higher again and then higher again, that has a lot more weight to it in my book. So, of course, we're going to have to see what happens Monday if it gets rolled again. But it is considered bullish to see them roll that call wall out of the way and give the market even more room to the upside to move. The put wall did not move. It stayed where it was. I don't know exactly what I want to think about that. From a safety perspective, I'd like to see it rolled up so that our distance back to protection stays at a relatively moderate level. Instead, we just keep getting farther and farther away from that put wall, and it's not getting rolled up to match our risk. So the risk keeps expanding. A break to the downside today can get us back to the 3-period daily moving average at 67.57, which is just below our own Globex low. If we can break that, we got large gamma 1 and then the volatility trigger. Zero gamma is a lot farther away. We have to get through the 10, break the roundy, get through the 20, and then you got zero gamma all the way down here at 66.75. That's a long ways off. We have a market maker move this morning, which is interesting because we're not going to get the jobs data this morning. What are they hedging for? I didn't see anything on the economic calendar that would suggest they need to hedge. So they're worried about something, and it's not one of the known unknowns that we can see. You're going to want to pay particular attention to this. Now, if you haven't seen this market maker move signal before, this is not me giving you my opinion. I'm not trying to interpret some obscure signal and give you my opinion. This is very clear cut and obvious. They are hedging. Now, of course, they are always hedged. This is additional hedging on top of the hedging that they already had. So what that market maker move signal is doing, which we can also see it right here, is it's looking at the out of the money options in the front expiration, and it's looking at how they're traded. These out of the money options have implied volatility on each strike. As their trading comes in, it influences this implied volatility average here on that strike's expiration. When the front one gets higher than the next one out, we get this market maker move. Now, there's articles that you can read on this. Schwab now owns Thinkorswim, so you would want to Google, the market maker move Schwab, and you'll find their articles. They will not talk about futures in that article. They'll only talk about options. And usually they reference that to things like events, non-farm payrolls, earnings, those sorts of things, equities, not indexes, and certainly not futures. But it's all the same stuff, right? So when there is heavy trading in the front end, in the out of the money options, it jacks up that number right there, and it gets higher than the next series out, and we end up with a market maker move. It's as simple as that, right? So we know that they're hedging. This is nothing to be disputed. The question is, why are they hedging? If it was actually non-farm payrolls, that would make sense because that carries risk. But we don't have non-farm payrolls today. It's going to be delayed because we have a government shutdown. So keep your eye on the market maker move. At some point today, it will begin to fade because it will only be alive today, right? Those options in the front end, by the end of the day, they'll be gone. And so it cannot sustain itself throughout the entire day. It will start to fade. But until it does, we want to keep our eye on it and see, is it growing and continuing to get larger, or is it beginning to shrink? Whenever we past the event that's causing them to hedge, it will begin to shrink, whenever that is. It's very likely we'll see headlines to go with it, but they could be protecting themselves against something that never even happens, and then we won't see a headline, we won't see an event, and this will just slowly start to fade away, and we'll never know why it was there in the first place. So this is your warning. Watch out. They are worried about something, and they're worried enough to put money on it. And this is not a trade for them. This is just cost. It's like lighting the fireplace and throwing money in it. You don't get it back. It's gone. And yet they are concerned enough that they are willing to throw that money in the fire. We got close to the upper ADR, close enough that we could count that as a hit. I don't like to, though. I'd rather actually see it hit before I count it. The ADR half is 67.92 cog line. I like that. It's a point that a point of reference that we shouldn't get through if today is going to be a lot like yesterday was. And I had mentioned yesterday that it was very likely we would just pull back and hang out. You know, it's kind of weird because we pulled back and just hung out. I like it, right? It's nice knowing that the work we're doing there in the pre-market actually turns into something relevant and useful. There are days that surprise and do something we weren't expecting, and then, we have to deal with it. But when we get these reversals and we're able to call it in advance, like I did Monday and Tuesday or yesterday with that sideways day, hey, just monetize it, right? That's the whole point. Anticipating what today's trading is going to provide, and then understanding the clues to look for to validate that argument. If we can get through our own Globex high, let's challenge this ADR half. The phrase, if we get to one side early enough, we can go to the other by the end of the day. Well, we're already halfway through the trading day, so we didn't get there early enough. Yeah, I believe if we get up there a little bit later, say before 9:30, we could begin attempting a run back to this other side, but it's not on the table from the idea that if we get to one side, we can go to the other, because we're already halfway through the trading day. If we get above this and close it and keep it, then we're going to aim for the next level up. We also have yesterday's mid and the 1, 2, 3, 6. What I'm marking out here is just the RTH of yesterday. Otherwise, we can adjust the upper end and we can measure all of yesterday, and that looks better. I think just capturing that little bit across the top and getting the whole thing done is probably the way to go today. There's the 2-bar reversal right against the 111. Nice pattern, and we've come down and tested that 786. That needs to hold at this point. Break that 786, we're headed back to the half. Get through the half, we're coming back down to the bottom. It really is as simple as that. Along the way, you got today's Globex low. And if we apply the spot gamma levels to it, we can see how it lines up with this big pivot from yesterday, 67.71. And of course, the 67.50 big options level got large gamma right underneath it. I would look for a lower high to get printed, right? I don't know that we're going to get it, but it would make sense from this setup to see price try to run back up, maybe get hung up on the mid between this. See if we can get that lower high to validate the continued drop. And keep your eye on the news because they're hedging for something. All right, today's floor pivot is higher than yesterday. That's bullish. Price opened above it. That's also bullish. It's not an MDP because we've already hit it, and that's considered bullish. Otherwise, we would have this expectation of coming back down to hit that pivot. It's a narrower channel, and narrow channels imply that if we break out, it sticks and we continue to run. But we did break out and it didn't stick, and we came back in again already. So that's kind of off the table. If we get through the floor pivot and begin to expand beneath it, yesterday's floor pivot will become a nice target to aim for. That's getting through yesterday's low and expanding beyond that into a 1, 2, 3, 6, which would or should line up really close with this floor pivot, which is really close to the 32 cog, by the way. We've already made R1 and we attempted to get above it and it failed. That's a really strong signal right there. I have seen this happen and then we do get back up there, but it's kind of rare and it usually attaches itself to some form of news. So unless we get news that can turn this around now and get us back up here, we're done with this level. And it's more likely that we're done with it for the day. Now, news can change that, right? And I can't anticipate some unknown news that we don't even know is coming and whether or not it's going to move this up there. But without some headline to give us that push, I don't see how we can make a new high against this at this point. There is the concept of R1, S2, and that is not bearish, even though I just pointed at 67.22. It's not bearish to look there because it's just wave function, right? At some point, you got to pull back. It doesn't mean bearish just because you pull back, right? Look at yesterday's pullback. Nothing more than that, right? Just a pullback here, there, just the way price moves. So R1, S2, that is a thing. Just like S1, R2, that is a thing. If we were looking for it to get above R1 and get to R2, this is the sort of behavior we would have expected. That it attempted to go back down and it wasn't allowed to and it ran up, buzzbeat off that, and then continued to go and got into R2. That's not what we got this morning. So S2 is on the table. It's still level by level though, right? We're back inside of the previous day's range. We got to get through this 71 pivot, floor pivot, yesterday's low, S1, yesterday's floor pivot, S2. There's a cog line in there, big options level, gamma, blah, 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 all that stuff, right? Yada, yada, yada. What an ugly profile. 6711 cog line is this profile's point of control down here. Not perfect, but you know, it's close enough. We have the shallow area here. So if we do break this 6742 pivot, then that's the goal, right? Get through 42 and you can come on down into 6708 or that 6711. Back in the day, 42 used to be one of the validated cogs. It's not anymore because I don't spend 3 months validating these cog lines like I used to, but there have been numerous occasions where 42 was one of the cogs. So it happens to be a level I pay particular attention to. We can see last week, the 42 area had a lot of work done to it too. It's just interesting that it was shallow this week, but it had a lot of work put into it last week. This shallow area, we can fall through it fast. Now they came in and put in some support here, right around that 67.42, but it was just a little bit of work. And maybe that's nothing more than a speed bump today. We'll have to see if we even get down into those levels. I'm not bearish, right? I don't know if that hasn't shown up in any of this. I'm not bearish, but I do expect that we got to take a break. There's this old concept called the 5-bar rule, right? And don't count today because today isn't done yet. 1, 2, 3, 4, 5. That's 5 bars in a row of the same type. This day doesn't count because it's today, and today ain't done. So in the 5-bar rule, it's exactly like it sounds. On the 5th day, we rest, or after the 5th day, we take a break, we get an opposite candle color, right? We're not talking about going in the other direction, selling off, big moves, just opposite candle color or a doji. And you can find plenty of examples where the market put in, 8, 10, 12, 15 candles all in the same direction, and that the 5-bar rule didn't work. And that's because it's trading, right? There is no 100% to anything. So a lot of times 5-bar rule works, but not all the time. The only guarantee that I've ever seen in trading is that if you don't take care, you will lose your money. That is 100% certain. I think that's the only certain one that I've ever come across when it comes to trading rules. This is the cumulative volume index. We don't look at it all that often, but it just because I don't show it doesn't mean it isn't useful all the time. It's set to the NASDAQ, but you can, set it to other things. If you're looking at it on TradingView, you can actually combine your markets and you can look at the Dow, the S&P, the NASDAQ, all of them combined, which I like that better. If you search on Thinkorswim, just search cumulative volume index or maybe the CVI itself, right? Use the letters. You won't find this, which I'm more than happy to share. I don't care. I made mine with Bollinger Bands around it, and then I added moving averages to it. We're still above the 10, the 20, the 50, and we're not pressing against the upper edge of the Bollinger Band. So we're not overextended. We're not overbought. We haven't moved too far too fast. We're not even getting extreme, and we're still healthy. Pointed to the right, have a fork pattern in the moving averages. There's nothing wrong with volume. This is showing net buying is still strong. I don't want to short that. Ten-day, 30-minute volume profile in TPO. We still don't have a movement in this point of control. As I mentioned before, we're going to start wiping out the candles that made this point of control throughout today and into Monday and then into next week. As we wipe those candles off the board, this point of control will move. It's very likely going to have a small stay at 67.50 short term, maybe a day, 2 at most. And then it's going to move somewhere else, maybe up here into 67. Maybe it'll be somewhere else if we fill this out between now and next Tuesday or next Wednesday. But that's what we have, that it's going to be moving soon, and it's very likely going to move closer to us. The concern is that it ends up being over our head, right? Say we fade down to Thursday's lows and we close down there. Then next week we come in and we find that this point of control has actually moved up and it's over our head as a resistance zone. That hasn't happened yet, so we're just trying to look ahead. Otherwise, we don't have any pattern here at all. There's no classic shape, no real good insight. This is just sloppy, nasty stuff. We don't have a new VPOC from yesterday because we've already cut through that zone. The textbooks will tell you to carry these lines forward, right? I don't do it. I've got enough pivots already, but the textbooks would say mark the value area low and the value area high and the point of control and carry those forward into today's trading. If you want some additional insight, they provide it, right? They really do. They provide some insight. I've got enough pivots. I don't need them. Generally, what I mark out is the VPOCs, the untouched points of control, like these back here. If we can find where they were at. Right, so on these days where I've marked them, these are actually old ones. We can go ahead and take them off. They're from the last contract. We don't have any new VPOCs to the downside. I don't carry the ones from the previous contract because we don't have to worry about trapped traders or anything like that. Those contracts don't exist anymore. To me, there's just no reason to keep them. So when we get new VPOCs, we'll put them on. What that term means is that we look at yesterday's price, where the point of control is, and we look at where price is now and ask, has price moved through that area where that line is? If it hasn't, then we just keep carrying it forward every day, every day, every day until finally price goes down there and hit it. But if we look at where that line is and we see that price has already hit it, well, then it's not an untouched point of control anymore. It was touched. We're done with it. We don't need it anymore. Take it off. There's quite a few indicators on TradingView that have that built in already. And I'm not 100% certain, but I think their point of control has a default setting that you can apply that will carry forward the point of control from the previous day's trading. I don't think it does all of the previous days, I think it just does yesterday, but check it out. Maybe it does. On Thinkorswim, you have to have a custom one if you're looking for it to be drawn for you. I don't like it drawn for me. I want to do the drawing myself. You know, licking windows and eating crayons, kind of the highlight of my day. As with every Friday, we have a preview of next week's trading range. And one of the things that I like to do is compare the week that we just had to the anticipated week that we're going to get. These ranges are built based on two factors, time and volatility. So if today or this week was a 5-day week and next week is a 5-day week, then the time is the same. They both have 5 days in their measurement. So if we measure the weeks and we compare them to each other, if one is bigger or smaller than the other, the only difference, if time is the same, is that volatility is different. Next week's range is wider than the current week that we just had. That implies that they are pricing in volatility for next week. Some depth or background on this, because it's kind of tricky. If there was a big event next week, the range would actually be smaller, not bigger. And that's because big events suppress volatility. Think like FOMC. FOMC is a volatility suppressing event. And if FOMC was next week, we would expect this range to be narrower, not bigger, because the market would price in at least 1 day of sideways, maybe 2, and they wouldn't expect that we could travel as far. And so it would be suppressed. And it took a long time over the years for me to grasp that logic, right? I always believed that if it was a narrow range next week, then the market just wasn't seeing any risk at all. Well, you can imagine how often I got my butt handed to me when that narrow range week got a lot of volatility and we expanded and it ripped right through me. So just because it's narrow on the face of it doesn't mean that there isn't any volatility next week. It very often means there's something really big coming next week and the market is anticipating a sideways day to go in front of it. When we have big ranges like we're looking at next week, This implies the market is pricing in volatility, but it doesn't exactly have a connection to a specific event. It's not FOMC, CPI, non-farm payrolls. It's none of those things. It's something else. Could be the start of the new earnings season. It could be the new QRA, right? We're going to be getting into those. It could be all kinds of stuff. But the main takeaway is it warns us, hey, they are pricing in volatility next week. Why? And so I see this and I know to spend some time over the weekend trying to figure out what they're scared of or why they're worried and what they're anticipating that could be so volatility inducing. And it won't be a big headline thing like CPI or FOMC. It's going to be something more subtle than that. So it helps me focus where I should be looking to find those answers. We're going to keep that box here and we'll look at it again on Monday. This range that we're looking at is not set yet. The gray line is our current price. The green and the red line is the projections that are still alive and still moving right now. After the close today, this range will lock into place, just like all of these previous ranges are locked. It won't move anymore. And then we'll have our for sure range for next week. But right now, this is just a preview of what it could be. We are currently at this week's range edge. It wasn't to the tick perfect, but we got pretty darn close. Really close. Maybe that did get to the tick perfect, but we've made the move for the week that we were expected to get. And we're supposed to close inside this box 70% of the time. That's 7 out of 10 weeks we should close inside the box. You can see last week, for an example, we wicked outside and we came back in and we closed inside the box. We didn't do it that week. We closed outside, but we closed inside here after leaving the range and coming back in. So that's our expectation. Maybe we test this edge one more time before the end of the week, but otherwise the expectation is that we fade back a little bit, that we don't get a breakout that sticks, and that we just go into the end of the week. It is worth noting this inside day. It's not IX10 because we are already outside of the big bar that would have been control. But this is our inside day. And it doesn't owe us anything. We could just stay here between the 4 and yesterday's high and just go into the close. Just like I mentioned yesterday, that it didn't have to be a big breakout run day. We didn't have to go higher or lower. We could just hang out and do nothing, which is exactly what we did. We could do that again today. It doesn't owe us anything. We don't have any real threats on the table other than why they're having a market maker move. We don't know, right? But other than that, there's really nothing. And it could be quiet. But I want to add that if things start to get a little frisky, we have not seen any panic selling at all. Nothing. Even this pullback here was only a 2% pullback, and it was very neat and organized and systematic. There was just nothing scary about it. But in an accelerated sell-off, if anybody starts to panic, it can pick up speed and we can get to 65 very easy. Yep, I said 65. You know, the futures have lock limits, although I think a lot of traders that are listening to me maybe have never traded when lock limits were triggered. That's only a 3.5% move. That's nothing. You'll trigger lock limits when you get past 7 something. Imagine, right? We're talking like 63, 6,400, and then triggering some lock limit underneath that. This move down to the 50-day, we could do that in a single shot. And it wouldn't even be considered an outsized move at this point. It would just be what everybody's been expecting forever and ever. It's a 3.5% move. 3.5%. That's a pretty good day, right? On the other hand, we can get to 69 today. The good old 6.9. We can do that very easily. That would be a 2% move from where we opened last night, right? Give or take a couple pennies. We can make a 2% move on a Friday very easy. So I get it, right? You want definitive answers that it's going to be bullish or it's going to be bearish. My base case today is that we're going to do what we did yesterday and hang out sideways inside of yesterday's trading range, and that we're just going to go into the close, keeping what we took for the week. All we got to do is stay inside of yesterday's range. But make no mistake about it. If we get through yesterday's half, then it puts on the table yesterday's low. If you get through yesterday's low, then you have the 10. You get through the 10, you got the 20. It's what opens up, right? You always got to ask, now that we made this level, what has opened up? What's the next level? That's our levels all the way down. We're only 0.73% above the 10-day moving average. That is not overbought. It's not overextended. We have not moved too far too fast, and it does not owe us a pullback on this time frame. We could move another 0.75% to the upside today, and we still wouldn't be overbought or overextended. We would just be to the edges of the comfort zone. And if you look at it on the weekly, we're only around 3.25% above the 10-week. So it feels like we're outstretched. It feels like we have gone too far too fast. But this says we're good. We're a little extended, but we've been more extended than this in the last 5 years. And we were able to keep it and go even farther than that. But when I set my mouse there and you look back to the left, typically, if we get above 3.5, we don't stay there for very long. We get above it and we don't keep it and we come back in. And the times where we have stayed above it for more than one bar was usually attached to news, right? That it was headline news and that we stayed up there for a few days while the market, kind of burned through that exuberance. So don't think that this market owes you some kind of move to the downside simply because of how far we've moved to the upside, because all of this is telling me that's not true. If you don't want to use the 10, get yourself a Z-score indicator or something like that, right? Try to find an indicator that defines the mean. You use something like that. I like using the 10, but, to each their own. My sandbox, I'll play with the tools that I want to play with. So looking at things that are down this morning, a little bit of XXX China is down, but it was up almost 12% in a 5-day period. Kind of needed to pull back a little bit, right? That's not much of a surprise. Plus, it's the XXX. And then we got Nat Gas, which was up almost 9% in a 5-day period. Getting a little bit of a pullback's not a surprise, right? Especially for that thing. And it's Nat Gas. Now looking at what's up, you got space, UFOs, emerging markets. That's China. The Mag 7, not up enough, but moving in the right direction. So we want to see more of the good stuff. Chips, Mag 7, consumer discretionary technology. We want those up more. We got the mags, but it's not enough. And then we got the homemade mag. That's also, we need 0.5% here, and we don't have it. But these are moving in the right direction. All they got to do is follow through, and you could get that breakout rally day. Looking at what we have right now, you can't get that breakout rally day from the Mag 7 or from growth. It's going to have to be from 0-day flows, bonds, treasuries, commodities, something other than the sectors the breadth of the Mag 7, because this isn't going to get it done. The fact that they're not negative is a good start. And if they do come in and begin to participate, then awesome. You could get that growth rally breakout, but not with this. So at least you know what to keep your eye on. You got the market maker move. They're hedging for something. Keep your eye on the Mag 7 complex to see if it actually starts to pick up a little bit. This is the way that I generally do it. Just slap it on a chart and put the VWAP on there. If it gets above VWAP and it's trying to hold above it, then you got a chance. Keep your eye on financials because, of course, you know it's a dual influence system. And then you just got the breadth, and you can cycle through commodities and treasuries to see if you're getting any flows out of that. Add to that some 0-day insight, and you're good. You've got your finger on the pulse of what's happening. And if we start to get a rally or a breakdown, you should see it in one of those products as the cause. Yeah. So I got for you guys. Be careful, be safe, have a good weekend. I'll see y'all next week.